You need money to get your startup off the ground or to launch it to the next stage. That's quite clear. But who is going to give you the money and why? In this video, we are going to take a look at the different types of investors and their motivations. There are four main groups of investors. Let's start with friends and family investors. People closest to you are most likely to support you on your entrepreneurial journey. That's why many startup founders choose to use the money of their friends and family members for their first round of funding. It's a great way to get your startup off the ground, but you should definitely talk about the involved risks. Most startups fail, and the chances that your friends and family members won't get their money back is quite high. The second type of investors are accelerators and incubators. So many founders don't start their companies with a pre-existing network of venture capitalists or the knowledge on hiring a team, building a product, or raising capital. Accelerators and incubators aim to fill this gap by providing selected startups with a mix of network, knowledge, skills, but also some money. But all of these, like accelerators and incubators, can be very different. Some are just providing you with office space, some with a founder bootcamp, and some also with a significant amount of money. In exchange for all of these startups typically give up away like 2 to 10% of their equity. Always make sure that the services and money they provide are worth it for you. The most well-known accelerators are Y Combinator, Techstars, or OnDeck. And they have produced some of the world's greatest companies. Companies like Airbnb, Stripe, or Instacart. But let's jump over to the third category, angel investors. Angels are investing into your company with their own money. They are wealthy individuals that are often successful entrepreneurs themselves. Angels are really important for the whole ecosystem because they can provide valuable advice beside their money. They are also often the entry door to venture capital investors. One special thing about angels is that they might be okay with lower return expectations in comparison to VC investors because they are using their own money. Last but not least, we have venture capital investors, or short VC investors. Unlike most angels, VCs are able to invest millions and millions of dollars into your company because they pool money from a whole bunch of people and institutions. The high-risk nature of VC investment means that they are expected to deliver very high returns for their own investors. So, as you can see, angel investors and VCs will be the main source of funding for most startups. And that's why I always tell the founders I'm working with that it is very important to understand the history of venture capital and how VCs in general tick. To understand the world of VC, we have to go back to the 15th century. Maritime expeditions could be considered the first primitive form of venture capital. Just as navigators were the most adventurous entrepreneurs of their time, ship owners were the first venture capitalists. Navigators were sent out on expeditions to find valuable spices and cargo in general. But such an expedition needed a ship, they needed a crew, and also food. And ship owners provided all of it for a share of the potential profits. So, if a ship went to the sea, the outcomes were either a total loss, in case the ship sank, the ship came back without any valuable cargo because of pirates, or the success case in which huge profits could be shared between the navigators on the one hand and the owners of the ships on the other hand. Some things have changed since then, but in general, the logic is still the same. So, today, most of the venture capital investors work like startups themselves. Other people give them their money to make more money out of it. They do that by investing in a group of different startups. That's called their portfolio. Out of these startups, there will be a lot that won't make it because they are running out of money or won't find product market fit. So for these, the investors will lose all of their money. Some of the startups will become sustainable businesses that make some kind of money, but that are not a huge success or anything. These companies might return something in the range of 1 to 3 times the invested money. And then there are the breakthrough companies, the ones that really found something special and that can change the world. These are the ones investors look for, the unicorns or today's decacorns. Because with these companies, investors can get 100 or even 1,000x on their invested money. And these are also the companies that are responsible for most of the financial returns of a VC fund. But what does that mean for you? If your business does not have the chance to become at least $1 billion or more company, it won't be interesting for most VC investors, because it does not make any sense for them to invest in your company. But that does not mean that you won't find any investor. You can still find someone who is working in a different logic. These can be angels, family offices, or specialized funds that follow a completely different structure of their portfolio construction. Besides the pure logic of a VC fund, there are several things investors look at when deciding for or against an investment. Every investor will have a little bit of a different approach or framework, but in general it's about 3 things. So, the first one is innovation. Does your idea have the potential to change the world and become a huge success? Or is it just something that is a little bit better than the things that are already on the market right now? The second one is execution. So, what have been the first steps that you have taken so far, and how did they play out? This can be everything from interviews to revenue or customers. The more validation points you have, the better. The third one is credentials. This is about the things you as a founder have done before. Have you built a company before? Have you worked as a domain expert in the field? Or do you have any other special qualifications that could be interesting for the investor? Looking at all of these 3 areas, investors finally come to a conclusion. And if you lack something in one of these 3 areas, you have to be even better in the other ones to get funded. So now you know how investors tick, and you can use that to adjust your own pitch.